Hello and welcome back to our channel. In today's video, we'll be discussing how companies get included and drop from the S&P 500 index. Part 1, Selection Process. The S&P 500 is made up of 500 large cap companies listed on the U.S. stock exchanges. The index is maintained by S&P Dow Jones Indices, a division of S&P Global. The selection process for the S&P 500 is based on certain criteria. Firstly, a company must be listed on a U.S. stock exchange and have a market capitalization of at least $8.2 billion. Secondly, the company must have at least half of its shares available for public trading. Thirdly, the company must meet certain liquidity requirements, such as minimum trading volume and free float. Finally, the company must have positive earnings over the last 4 quarters. Once a company meets these criteria, it is then evaluated based on its sector representation. S&P Dow Jones Indices aims to have a diverse representation of sectors within the S&P 500. Therefore, if a certain sector is already overrepresented, a company from that sector may not be added even if it meets the other criteria. Part 2, Changes to the index. Now that we know how companies are selected to be included in the S&P 500, let's look at what happens when they get dropped. The company can be removed from the index for several reasons, such as bankruptcy, merger, acquisition, or significant decline in market capitalization. When a company is removed from the S&P 500, it is typically replaced by another company that meets the selection criteria. The replacement company is selected by a committee at S&P Dow Jones Indices, which aims to maintain the diversity and representativeness of the index. Part 3, Impact on the market. The inclusion or exclusion of a company from the S&P 500 can have a significant impact on the market. When a company is added to the index, it can lead to increased demand for its shares from index funds and other passive investors who track the S&P 500. This can drive up the stock price and increase the company's market capitalization. On the other hand, when a company is removed from the index, it can lead to a decrease in demand for its shares, which can lower the stock price and decrease the company's market capitalization. So, that's it for today's video, and please subscribe if you did. Thanks for watching, and we'll see you in the next one.